welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. So markets keep trudging along. No ceasefire, straits open, not open. I don't know, but headlines are definitely driving the marketplace. Earnings aren't bad. We haven't had anything that has been outrageous. No companies have came in and we had a little bit on the banking side of things. We saw a little bit of weakness in Citigroup, and some of the mention is consumer concern, a little bit higher debt. So the consumer has been resilient. It still is. That term gets used a lot throughout. I mean, resilient, I think, is the key word if you do a keyword search as far as earnings reports are concerned in the financials. Still have the credit concerns. That is still an issue, and it's kind of tamping down that sector a little bit. Also, we've seen a little bit of a sell-off in energy. Energy is not the strongest sector at this point in time, but we do see actually some good in the travel industry. We had a couple of, like, Viking cruise ships actually set a new high, sold off a little bit today and yesterday, but it has shown some strength. That might have a little bit to do with actually the price of oil staying high, up around the $100 level, back to 80, up to 110, back down to 100. So the volatility of oil is definitely hurt in some of those spaces. United Airlines came out and had horrible numbers and went up. So we actually, I don't know, I'm going to look in my portfolio. Don't go there quite yet, but I'm going to look. Yeah, we don't have that United trade in, but I do have the United trade on in my other account, and I haven't closed it out yet. But United Airlines, once again, just announced horrible numbers. And then it basically, the stock has been strong all morning long. So right now we're seeing United. I'm going to pull up the quote real quick. United is down $5.25. Oh, so it reversed. Nice, good. So I got to close out. I got some long puts on United that I have to close out, and that trade worked out excellent. The 97 strike put, it's not in the paper trade portfolio. I know that we talked about it. It was in here, and we talked about doing that trade, and I know we did it on the show where we did the calendar spread. The short one expired worthless, and now we're long the 97 puts. So here is our options grid. That's nice. Down 545 on that trade. All right. That's going to be a winner chicken dinner. All right. So here, we're looking to look at Tesla today, and they're announcing after the close. Oh, and GE Vernova, which I see in my notes over here, we put that trade on Monday, and we really wanted to do a skip strike, but we couldn't get it done based off of the skew. And sometimes it's annoying the way the skew is. It's annoying when you want to do a strategy and you can't make it fit. It just won't work. Where that's what happened with GE Vernova, and it has a lot to do with the underlying price. Underlying price of a lot of people discount what is the option, the actual underlying trading for. And the fact when you're dealing with a stock that's trading for $1,000 as opposed to $10,000, it changes the dynamics of the options. And what on a percentage move, what is a 10% move on a $1,000 stock versus a $100 stock? It changes all the dynamics, the width between the spreads, everything that goes along with it. And we tried to do an skip strike butterfly on GE Vernova, and that would have turned out great. We would have done really well on that trade, but we couldn't get it done for net credit. So we aborted. We actually did a put butterfly. We tried to be bearish, thought that it might hold right around that 1,000 level, and you did have some bearishness in the stock. So let's go back and look at it. On Tuesday, we got a little bit of a sell-off in GE Vernova. There it is. We got a little bit of a sell-off and the trade was looking all right. You could have potentially got out, but vol was still high. It would have been really expensive to get out. I would not have gotten out of that trade. And now today so you got a few days. It still might sell off. It's up 12%, 125 at this point in time, but it could sell off quite over the next couple of days. I would definitely leave it in. I'm not going to try to close it out. If I could get my money back, if I say I don't want the cheese anymore, just let me out of the trap, I would look to do that, and I would get out of the trade. Paid about $5 for the trade. See where this ends up at on Friday. You have a few days left in that trade. All right. Well, actually, we went out a little further too. I never did get it filled in the option trading portfolio. Let me actually pull up the notes here. How far did we looked at two different trades on it. April 24th expiration is Friday, and that was $5.45. We tried to get it filled around $5. We never got filled on it. Yeah, and we didn't go out any further. That was the one trade that we had. Okay, so let's look at Tesla. Let's put an order in on Tesla today. And I'm going to remind you that on Fridays now, it's called Fundamental Friday. And if you have anybody that's doing basic option trades and like to learn about the fundamentals of options, every Friday we pick out a fairly basic strategy to go along with the 4 videos that I put together. And if you do sign up for a paper trading account, you can trade right along with me, place those trades, execute those trades through the basic platform of Tradier.com. And it doesn't cost anything to open up the account. You do got to give your information. But if you do that, then you will have the ability to execute into the trades on Fundamental Fridays right along with me. We're going to get them in a trading portfolio. We're going to look at them and review them. The last one that we did was a protected put on Apple heading into their earnings, which is coming up this week already. And that's where we're at. So Tesla's up $4. The chart's all over the place in Tesla. But strong move recently, showing some strength, coming all the way back to the 390 level, and we're hanging out right at the 200-day moving average. And so we bounced off of that. That provided a little bit of resistance to the upside. 50 days hanging out around the 20-day support. It's always tough with Tesla looking at the chart. The chart, from time to time, there's been hints as to where the market is at. Fundamentally, PE ratios, all that stuff never really apply. It's all about what Elon Musk is willing to say after the earnings report. Most people hang on that. Is Tesla really a car company? Is it a robotics company? Is it a power company? What is Tesla, and what is Elon Musk going to say that it's going to be after this earnings report? So what are we going to focus on the next quarter? So I do think I don't mind getting along this underlying at this point in time. Like I said, usually if we can get a little bit of a burst through the 200 range, we can have some upside in the underlying stock. So let's look at a skip strike to start with out of the money, which is going to bring in a net credit. But I'm also, instead of switching it up like on Vernova, we ended up doing an open wing with puts. That trade didn't work out. And we've definitely had way more winners than losers around our earnings reports. But I'm going to look at the skip strike, and then I'm going to come back. And if that doesn't work, we'll go a fairly wide open wing. It's going to be fairly expensive. So I'll give you both of those trades today. All right. So if we're doing the short-term trade, the fact that they announced after today after the close today, that means you got all day Thursday, all day Friday, 2 days for these option contracts to live. So we're going to look at the expected move over that 2-day period. Underlying stock is at 390. If we buy the 390 call and we buy the 390 put, I did end up buying 2 of those. We're looking at $21. $21 on a $390 stock, and that kind of makes sense, because if you look at where the 1 standard deviation move is in the Tradier Pro software on the actual chains, we're right at about $21. So 390 plus 21 is going to be 410, 411 right in this spot. and that's usually right around a 20 delta. So we're at 415, close. All right, let's start right here. Let's center it around where the expected move is at, plus the 1 standard deviation move. Okay. So this is going to lean bearish a little bit. Sell 2, buy 1, sell 2. I don't mind that. That's 5 points. See if we can get 7 points. 22.5. Yeah, well, that's feasible. Let's look at this. Let's go 415 and sell. We're going to go 7.5 points higher. Sell 2 of those. And then if we go 5, can we get this done for a net credit? Buy. Too many likes, dang it. Okay. Buy. Sell 2. Buy. Dang it. Yeah, we're going to have to go 5 points on it. All right, so let's adjust. Let's go here. Buy. Sell 2. Well, that's going to be a net debit. That's the open wing. Sell 2 of these, and okay, and buy. All right, 31-cent net credit. If we go 5 points wide, that gives us 5 points of risk, 30 cents on that trade. Maximum we could make is $5. Okay, so here is the skip strike. Here's the skip strike butterfly, in that the market is trading down here. If the market goes and closes close to the just over the expected move, right at the 420 level, if it happens and it lands there, we could make 5. If it goes another 5 points, that's where our break even is at on this trade. So now we're beyond a 1 standard deviation move. And if it continues on up, the most that we can lose on this trade is the net credit minus the $5, which is the difference between the long spread and the short spread. So $4.70 if we got this done for 30 cents. And that would be the, this would be an skip strike butterfly done for a net credit to the account. 30 cents is okay. I mean, if you're looking at doing this trade with only 2 days remaining, the alternative would be that you're just looking to sell the 420 and buy the 148. So in that trade, you're looking at about $1. So we're bringing in 30 cents here. If we just did the short spread from 420 to 430, and that was our maximum risk of, well, it would be 5 points. We'd want to go at 425. 190. Yeah, so that would be about 50 cents. 192 is what we'd be selling. 145 was what we'd be buying, because that's where our risk is on this trade, from 425 to 145, and that's about 50 cents. So we're bringing in a net credit of 30 cents. Let's move it down a little bit. We're gonna keep that in the what if calculator. 30 cents with the potential to make $5. $5.30 would be the maximum upside. And if the market comes this direction, we're okay. We just don't need it. We need it to not make a 2 standard deviation move to the upside. So I'm going to adjust it and see if we can get this done for about a 50-cent net credit. About 10% of the risk is always what I like to get, if that's feasible. So here we go. I'm going to clear it all out. And if we go down to right here, buy this one. We're going to sell 2 of these, and then we're going to go up to the 25. That's only 38. Only getting 8 cents more. Yeah, I don't like that one as much. Okay, so I'm not even going to send that one to what if calculator. I'm going to go back to here, and I'm going to summarize this, and then we'll look at a open wing that's bullish on the market. Now, this to me, this trade in particular is a butterfly, but I always bill it as an alternative to a short call spread. So if you're thinking of a short call spread, you're just trying to make a net credit to the account. If you're looking at a butterfly, a lot of times you're trying to hit the home run. You want it to meet right in the middle. This is a short spread with a hedge. I think that is actually the most proper name to give it. I like skip strike butterfly. People will call it a modified butterfly, but literally you're skipping a strike and you're embedding the short spread in it. So if I run back to the chains, let me explain. If we were going to do this trade and we were just doing the short spread, I'd remove these 2 legs. And this is where the risk kicks in the skip strike butterfly, is that strike that we skipped. So if I were to do this and I never heard of a skip strike butterfly, I would look at selling this option contract, the 425, and buying the 430. And at one point it was 50 cents. Now it's saying it's 45 cents. It's because your risk, where your risk kicks in on the skip strike butterfly, is from 425 to 430. And you can see that right here in the what if calculator. 425 is where your risk kicks in to 430. Just like the short call spread. Just like the short call spread. Okay. Work with me here. So that is where the risk kicks in, and we'll send this to the what if calculator. I'm trying to send it to the what if calculator. And then if you do the open or the skip strike butterfly, what you're effectively doing, the best that I've always been able to explain this is you're taking some of the credit from the short call spread. You're taking some of the credit from the short call spread, and you are using it to buy a hedge. What is that hedge? Basically a butterfly. You're buying but you got that one strike that you're skipping, but you're adding that hedge in that protects you. And that's where, when you have volatile marketplaces, you can do this, get about 1 standard deviation move out of the market, and then end up with a smaller net credit, but you don't mind if the stock goes in the direction of the strategy. In other words, if it's positive and you have a short time frame, it's okay. You're going to be all right on that trade. So 425 right here, that's where the risk kicks in. 430 is the maximum risk. We go back to the butterfly. 425 is where the risk kicks in. 430 is where the maximum. Wow, we're getting 45 cents for it? No, we're not yet. That's going to be about 30 cents. Send a ticket. Yeah, 30 cents. All right. I don't mind this trade. You know, if you're doing a short spread and you're going to go out those 2 days, you're risking $5 to try to make 50 cents, 45 cents. Here you're risking $5. You're hoping to make 30 cents, but you have the potential to add another $5 to it. Ideally, if you do this trade, you'd like the market to open right around 400 and then start drifting up towards the 420. The only time you really get burned on this trade is if the market literally opens 2 standard deviation moves up above the 130 level and you had no possibility of trading out of it. That's where all the risk comes in. All right. And good morning, Kurt. I see you in the chat box. If anybody's got any questions, please do put them in the chat box. I'm willing to address them during the show. All right. So I don't mind this one. I would have liked that. I like that trade a lot better in GE Vernova. Tesla is up today, but GE did actually sell off a little bit going into earnings, and now it's up strong today. And that would have been this would have been a real good example of a trade that could have brought in a net credit and paid you because the market actually went up and reached somewhere around the expected move. Okay, so let's clear this one out. And now we're going to go something different. And we're going to stay on the call side of things, even though with the skip strike butterfly, you kind of lean bearish because you're bringing in a net credit. Anything that goes down, you're still positive. You still could make that 30 cents. You're risking $5. But in here, we'll go back and look at one of our open wing butterflies. And we're going to go fairly wide on it. We'll start right at the 400 level. So we're going to buy that. Let's go 15 points. Not a ton of premium there. 410, 720 and 410, 450. Yeah, let's hit the 410. Okay. And then buy this. What's that trading for? Yeah, that's cheap. 180 for that. So 220 above 420. I like the, once again, I like the way the skew is. I like the way that it's leaning. We're buying 89 vol and we're selling 92 vol. So vol is definitely in. No wonder why this is cheaper. This vol is increasing as we go up in strike. That is kind of a bullish sign that the out of the money calls are trading for a much higher volatility than the out of the money puts. Look, one standard deviation here on the 362.50 is trading for a vol of 90. What's the delta on this? The delta is 13. Okay, so it's probably 89. Let's call it 89. Let's look at this. Let's judge it by delta, and that's the 15 delta, and it's trading for 89. We go on the call side of things, and we look at the 15 delta, and that's trading for 94, right? 94 vol. So the vol skew is saying that the marketplace is willing to pay more for calls than it is for puts. And in general, in the options trading world, I've emphasized this many times, that options are considered insurance products. Like if you look in the S&P 500 index, the puts always pay almost 99% of the time are going to trade at higher volatilities out of the money than the calls are out of the money. So the skew is to the downside because it's an insurance product that can protect your portfolio. So a lot of hedge fund managers, or a lot of money managers in general, like to buy puts in the SPX in times of turmoil, or when they're concerned, or not, but just want to do some protection. So in Tesla, we're seeing the vol skew to the upside, and that is helping us with our butterfly because we're receiving higher vol here than what we're paying. So this is why this looks really, this is a good trade, or it's a good trade structure. That's the word I need. This is a good trade structure because of the way the volatility is skewed. All right, let's send this to the what if calculator. So once again, I kind of wanted to lean towards the skip strike, but I guess the open wing is looking solid here. All right, let me click this. 180. So here's what it. So this is the numbers. All right, here we go. We're looking at Tesla. We're going to look at an open wing butterfly. This will be the paper trade around Tesla's earnings, which is announcing tonight. We're going to buy the 400 strike call with the Friday expiration. Expiration is not going to change. We're going to sell 2 of the 410s, buying 1 of the 415. That makes that our long spread is going to be 10 points wide on our butterfly, and our short spread that makes up our butterfly is going to be 5 points wide. We're able to get this done right now. We're going to say $1.80. I think that's a good price. So $180 per 1x2x1 open wing butterfly. And that means that anywhere above 415, if it blows these numbers away and it finishes above that level, makes at least the expected move to the upside. we could make $2 or $3.20. So we put it on from 180. The maximum we could trade for is 5. We would be up $3.20 or $320 per 1x2x1 open wing butterfly that we executed. Vol skew is a big reason why this is so inexpensive, considering we have a real solid risk reward. Now, if the market does go down, and if it's anywhere below 400, well, we can lose the maximum on the trade, which would be that $1.80 or $180. But our upside, if it lands right at our middle strike, the 410, that means that the butterfly could trade for as much as $10 minus that $1.80. That means that you could make as much as $8.20 or $8.20 if it landed somewhere close to the 810 level. And I'm trying to show that right here with my mouse at this point in time. So volatility skew makes you lean once again towards this open wing butterfly. As a matter of fact, we might even be able to get it. Let's look at selling a little bit different vol. This is going to be the official paper trade, and we're going to send this down to the trading floor. So let's send it and get this order working. Boom goes the dynamite, and the order has been sent. All right, now I'm going to adjust this, and we're going to look at one more butterfly. We could go out. Do we go out to May 9th? Let's see what the skew is looking like on the May 9th expiration. We do have alternative expirations here too. So May 1st, 9 days away. May 1st is the Friday expiration. All right, let's look at this one. I'm going to clear this out. We're going to go out 9 days. And let's consider the same trade. Let's see if the vol skew is still in this here. Yeah, 56 vol at the money, selling out of the money 60. Let's target the 425. Yeah, we're getting $3.90 on that. Let's go 15 points wide. Let's see how cheap we can get this done for. Because of the volatility situation. So we're going 10 points, 15 points here. We could go 7.5. That's $2. Let's try it with 5 points. Wow, that's the same price. Isn't that interesting? Huh. So a dime more, $1.89. You're giving yourself a little bit more now. So we gotta talk about this for a second here. Oh, looks like our butterfly just filled. Nice. Here's our order. Yep, our butterfly just executed right here. 400, 410, 415. Okay. So if you look at this, you'd say, well, Brian, you can go wider on our open wing butterfly, have a potential to make more, and you have more time. Now, in this issue, in this instance, if you're doing a butterfly, you're selling 2 option contracts that you are hoping become at the money option contracts. At the money option contracts hold a lot of time premium, a lot of time value. You want that time value to go away if you're correct on your forecast. So by going out further in time, we get it done for cheaper. We got a little bit more upside. We got the same. Well, we got a lot more upside on this in this instance on Tesla. But the downside is that it's going to take longer to get paid. And the only way that I can really highlight that is if we look at the what if calculator with this butterfly, with the May 1st expiration. I'm going to send that to the what if calculator. And with that scenario, there's the May 1st. You see the green line here? When you first put this trade on with the volatility and the market goes up, this it's still a positive delta trade all the way up and beyond our strikes. But this doesn't start moving until we get closer to the actual expiration date, because you need the middle option contracts to decay. So over time, if we change this date, let's go to the 29th. Now you start to see the green line move. And let's go one more chunk. Let's get closer to Friday. Let's go to 30. Now, what can make that line move if you're correct on your forecast? What are the two things that can happen? The biggest one is time decay, especially on our short-term butterfly, first one that we looked at, but also volatility can come in. And you always expect that after earnings, that implied volatility will come off. So we see time decay drawn it. If you adjust the volatility, eventually this is going to look like right at expiration. So the benefit of, if you're going to be right on your forecast, and by right, I mean you think that Tesla is going to go to 425 after the earnings announcement, that would be right. You want time decay. You want to be closer to expiration. So that's the benefit of doing this butterfly with only 2 days remaining, in that time decay is going to happen. You have all day Wednesday, all day Friday, and all that time premium has to be gone. So there's the difference between the two trades. But the longer term option looks good, and both of these look fairly interesting because what we're seeing in the option chains, what we're seeing in the actual volatility skew. So this one is, I'll pull these up. This one's the May expiration, and this one is the Friday expiration, the 24th. All right, let's execute the main one. We got the main one, 189. Let's look at both. Let's see if we can get an execution on this one. 180, we'll send it to the floor. Boom, order has been sent. And we'll look at both of them. On Friday, we're going to be doing Fundamental Friday, so we'll be doing a basic trade. We're not going to be talking about open wing and skip strike butterflies. But as I said, please share it with people. Let them know. We would like to promote this, like to bring more people into the option trading world. Tradiers behind it. We've got a great paper trading platform to be able to learn options with. So let people know. And the easiest place to go is hub.tradier.com. Set up a profile. It's 100% free. And we'll see you this Friday for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.